Now my chance of being the worst in the class.
Yeah, what's just all of that?
I'm like,
That we not think, well, that's wrong.
so I do well in the other.
I know.
Taking money out of corporation. Please turn in the textbook to page 509. So we're at kind of a watershed moment in the course. We've talked mostly about rules. So here's what you can deduct. Here's how you calculate this, et cetera, et cetera. These are the tax rates. Now we're into something which I hope is more interesting, which is, well, what can I do with all of this? And the first important thing that we can bring to bear to this is the integration principle. And you recall that we have sort of three different kinds of dividends. We got capital dividends, which are awesome because they're tax-free, as they should be. That's the non-taxable portion of capital gains. The second is eligible dividends, which come out of retained earnings that have been taxed at the high rate, the general rate inside the corporation, and then are being paid out to an individual, let's say. Eligible dividends are preferable for the individual to receive because they're taxed at a lower rate than non-eligible dividends. And the textbook here gives us sort of an ordering, which I need you to know, because your client will say to you, I want to take money out of the company. How best to do this? And number one is capital dividends all day long, and they are so important that, as I said last time, you should take those out the day after you have a capital gain inside your company. And the reason for that is because if you subsequently have a capital loss before you take out your capital dividends, well, that reduces your capital dividend account. Oh crap, I can only take out a smaller amount. Whereas if you take out all the capital dividend account, like empty it out right now, and you have a loss next month, there's no comeback that says you need to give back some of the capital dividend. You just carry for a while a negative balance of your capital dividend account. So we all day long want to take money out of the capital dividend account, like the day after we have a capital gain. Eligible dividends are sort of the next thing. So that's now a taxable dividend to an individual taxpayer. But as we said before, taxed at the low rate. And by low rate, I mean sort of 35-ish% as opposed to 40-some% personal tax rate on an eligible dividend. And the best kind would be to be able to get for the corporation a dividend refund. So for example, a refund of Part 4 tax that maybe the corporation paid. So these would be dividends where a corporation, your corporation, owns shares of a public company. And your corporation received a dividend, which would be an eligible dividend paid to it by the public company. Because public companies, all their income is taxed at the general rate. They don't get the small business deduction. So you paid Part 4 tax, your corporation paid Part 4 tax on that dividend, and it was an eligible dividend received by your corporation. Now when your corporation pays out a dividend, it can say, this dividend's eligible because I've got some GRIP, because I got this GRIP received from a public corporation by the dividend. Oh, and I also get a dividend refund. My corporation gets a dividend refund because my corporation paid Part 4 tax on that dividend. So that's the second best kind of dividend. It is taxable, but it is an eligible dividend, thus taxed at the lower rate to the individual. Plus, the corporation gets a dividend refund, so everybody wins. My corporation wins and I win. Let's pause there for a second. That's the best of all worlds, this number 2, because we both had eligible dividend treatment, and we had what's called eligible RDTOH. RDTOH can be itself eligible and not eligible. The reason for this is because if the Income Tax Act is going to give us eligible treatment and RDTOH, the best of all worlds, it wants the RDTOH to have come from having paid Part 4 tax. Otherwise, if the RDTOH came from, for example, taxable capital gains or SIV income, you recall that's allowable investment income. Income Tax Act says, hey, we're not going to give you both eligible treatment and a dividend refund. We're only going to give you this best of all worlds thing if you got RDTOH that came from having received an eligible dividend yourself, corporation, and having paid Part 4 tax on it. So this RDTOH thing has 2 components: non-eligible and eligible. The eligible comes from having paid Part 4 tax. On dividends we received, and the dividends themselves were eligible dividends that we got from normally a public corporation. Please turn to page 503. Eligible RDTOH is the kind we want and hopefully have. That's the kind that gives us a dividend refund and allows us to call our dividend paid to our individual shareholder eligible. It comes from Part 4 tax paid on eligible dividends received from non-connected corporations, also called portfolio dividends. You can imagine sort of having a stock portfolio. If I own shares in a public corporation, for example, it's such a small percentage that I owe that there's no way that my corporation would be connected with that corporation. You recall that connected is greater than 10% of votes in value. Or Part 4 tax paid on dividends from connected corporations to the extent that the dividends caused a dividend refund from the payer's eligible RDTOH. Probably thinking, what do I need to know for the exam? What you need to know is in the lecture notes that says that a payor gets a dividend refund. So that's the corporation that's paying the dividend. If it pays an eligible dividend from RDTOH. Or if it pays a non-eligible dividend from non-eligible RDTOH. Because if it's paying a non-eligible dividend from non-eligible RDTOH, it's a non-eligible dividend. So the Income Tax Act isn't saying, oh, you're having your cake and eating it too. The sweet spot is when we have an eligible dividend paid from eligible RDTOH, and that means that we paid Part 4 tax on a dividend that was eligible that came from a non-connected corporation. And 9 times out of 10, that'll be that we got a dividend from a public corporation. We don't have that situation, then we cannot get both an eligible dividend and a dividend refund.
Have we come across a non-eligible RDTOH
So far?
previous example so far?
Yes. A perfect example is where we have a corporation and it earned, let's say, rental income. Or it earned a taxable capital gain, thus it earned allowable, it earned aggregate investment income. That gave rise to non-eligible RDTOH. When we pay a dividend out of that, we get a dividend refund, which is awesome, but it's non-eligible, thus the shareholder pays tax at the high individual rate. It is non-eligible to the shareholder. An easier way to say it is that all dividends,
But wouldn't part of that aggregate investment income do RDTOH?
can you repeat that? I didn't hear it.
Wouldn't part of the aggregate investment income go into RDTOH when the dividend is paid?
Let's say that this aggregate investment income was interest income. It goes into the RDTOH when we earn it. The percentage that goes into the RDTOH is 30 2/3%. So it's sitting in the non-eligible portion of RDTOH.
Okay, because it's not technically taxed in that.
Oh, we've paid tax on it. In fact, we've paid so far 50 2/3% on this interest income.
So it's not part 4 tax.
But it's not Part 4 tax. It is Part 1 tax that we paid and provincial tax. And that 30 2/3%, let's say $307 out of $1,000 of interest income, goes into this non-eligible RDTOH. And then the day after, we pay a dividend. Assuming we don't have any of this stuff here, we pay this out of here, and we get our 307 back as a dividend refund. But it's a non-eligible dividend. Thus, we didn't have our cake and eat it too. We can only have our cake and eat it too if we've got eligible RDTOH, which probably came from portfolio investments, for example, investments in public companies. Because the dividends we get from them are eligible, and the Part 4 tax goes into the RDTOH, and paying out of this, we can get our cake and eat it. Dividend refund for corporation, and I pay tax at the low rate on eligible dividends. Any exam question on this will only be about principle. In other words, can I get a dividend refund if from day one my company has only earned, if my company's RDTOH only came from AII? Answer, yes, I can get a dividend refund. Would that be an eligible dividend? Answer, no, because I paid it out of non-eligible RDTOH. I might also have GRIP, but if I don't have eligible RDTOH, then I can't both have a dividend refund and eligible treatment for my individual shareholder. Thus, getting back to this ordering on page 509. I've blown through my CDA account. Now I'm going to pay a taxable dividend. I have to say, and this is the purview of the accountant, not you to calculate the account. Hey, I'm doing the dividend resolution. is this an eligible dividend or not? And is it a dividend out of eligible or non-eligible RDTOH? Because I, the lawyer, need to say that in the dividend resolution. And if my client had asked me if it's likely that I can have my cake and eat it too, I need to say to my client, go back to your accountant, see if you've got any of this eligible RDTOH or not. If you don't, then either you don't get the dividend refund or you don't get an eligible dividend. You need to have this golden stuff, eligible RDTOH, to be able to get both. And the most succinct place I know that says all this is in the lecture notes. Don't try to memorize it. Go back to the lecture notes when you're writing an exam. But just know principle-wise that I can't have my cake and eat it too unless I've got eligible RDTOH. And the reason, the policy reason for it, which is probably the most important part of this whole discussion, is that the government doesn't want us to both enjoy an eligible dividend and a dividend refund, unless we've got all of our eligibility. This was a problem for the government. People were paying, corporations were paying eligible dividends. Why not? Because they had over on the side here, they had GRIP. You recall that's 72% of general rate income, plus eligible dividends received from other corporations. And at the same time, they had RDTOH. And the government said, well, too many corporations are having their cake and eating it. We need to, and I think this is correct, only allow RDTOH treatment if the Part 4 tax came from GRIP of other companies. And that seems to be right to me, and it's actually fairly recent that this change came in. It was in 2018. This only comes to the fore when we're trying to take money out of a company. And hopefully we've got eligible RDTOH, that's the good kind, and it only comes from paying Part 4 tax. It doesn't come from paying the 30 2/3 tax on aggregate investment income. So if we've got GRIP and we've got aggregate investment income, if we want to enjoy a dividend refund and we want our individual shareholder to pay tax at the low rate on eligible, we have to pay two dividends. We have to pay a dividend out of non-eligible RDTOH, that'll get us a dividend refund, and then another dividend paid out of GRIP, for which we won't get a dividend refund because we don't have any eligible RDTOH. We have a quiz in the next class. I will, later this week, tell you what the quiz will cover. The quiz will not cover what I just told you, because I don't think it's reasonable to write a quiz on this, a closed book quiz. I can tell you that the midterm will have a question about this, because you will have the opportunity to have textbook/Income Tax Act/lecture notes with you. But be assured that our upcoming quiz will not cover 2 and 3. going through the order, let's assume that the company doesn't have any RDTOH in the first place, therefore not looking to get both a dividend refund and eligible treatment. The next kind of dividend to pay is an eligible dividend, paid out of GRIP, and there's no RDTOH, so the corporation's not going to get a dividend. That's what number 4 is. And number 5 is simply a non-eligible dividend. That's for a corporation that's paid tax on aggregate investment income. That doesn't have any GRIP, and therefore all it can aspire to is to get a dividend refund. The dividend will be non-eligible to the individual shareholder. That could also be a dividend paid out of active income, all of it taxed at the low rate, thus no part of that income went into the GRIP. That would also be a non-eligible dividend. And again, there wouldn't be any RDTOH there, thus there wouldn't be any dividend refund. Please turn to page 462. When we start a company, when we start a corporation, we generally put money in. And shares get issued for that. And the money we put in is called paid-up capital. The initials PUC. I might also call it PUC. Starting my company, did some projections, figured that I need to put in $100,000 to start. In my example, I put that all in as shares, and I take back shares worth $100,000. Let's say there are 100 shares at $1,000 a piece. Of course, that number can be any amount. It could be 1 million shares at 10 cents a piece. Let's just say it's 100 shares at $1,000 a piece. Anytime I want to, as a shareholder, I can take back that amount. Maybe not all of it, because there's probably some common law principle or statutory principle that says that I need to, as a shareholder, to leave some money invested in the company. Let's say, for sake of discussion, I want to take out $90,000, leaving 10 invested. So I do a so-called reduction to my paid-up capital. It was $100,000. I'm reducing it to 90. Pardon me, I'm reducing it to 10. That is, I'm taking out 90,000. That's a tax-free transaction. Because I didn't get any deduction or something like that when I put the money into my company. My investment came out of after-tax dollars. So I don't have to pay any tax when I take the money out. The only thing that happens is my adjusted cost base goes down. So for example, if I later sell the company for $200,000, my cost base, that is the amount that I use to figure out what my capital gain is only $10,000, not the 100 that I put it in originally. And that makes sense. My cost base should go down if I took out $90,000. It seems reasonable that my cost base is now only 10. As a result, I will have a higher capital gain than if I left the money inside the company. But that's fine, I understand that. My cost base went down because I took the money out. At the end of the day before the sale, I only had $10,000 invested in the company. Please turn in the Act to 84 bracket 4. If I reduce my paid up capital, as I have here, by $90,000, but somehow pay out more than $90,000, and I can't imagine why I would do this, but if I did, the corporation would be deemed to pay me a dividend. And so they should. Like, I've reduced my puck by 90, but somehow they gave me 92 or 3 or something. I would have a $3,000 dividend, and I should. But I have no other consequence to me. Nothing here says that I've got income arising or a capital gain or something arising if I do this right, which is declare that I'm reducing my paid up capital to 10 and take out $90,000. Elsewhere in the Income Tax Act, in section, I think it's 54, is where it says, hey, we're going to reduce your adjusted cost base as it should be. But the thing I want you to know is section 84, which is the thing that says no harm, no foul if you do this in a way to reduce your paid up capital and receive as much cash from the company as the reduction.
I have a question.
Yes.
When you request the paid up capital, is it a special dividend? Is it just a check? Is it just?
Excellent question. It's probably articles of amendment. So you have articles of incorporation that say these are the share class and all the rest of it, and likely says the amount of paid or the paid in capital or paid up capital per share is this much. So in our example, it's $1,000 per share. And we're now changing the articles to say the paid in amount, or for tax purposes, the paid up capital, is no longer $1,000 per share. It's $100 per share. We still have 100 shares outstanding, issued and outstanding, but the paid up capital is now only $100 per share, not $1,000 per share. So it's not a special dividend, it's not a dividend resolution or any other resolution. It's actually amending the constating documents of the corporation.
But how does the corporation actually get them the money?
Oh,
Like, I physically want $90,000 in my hands. How does the company do that?
the
Like-
company writes a check to the shareholder.
Okay, so it's just an accounting check thing.
That's correct, but the underlying legal document, one of my favorite quotes in a court case, the judge is spanking an accountant. Bad choice. It is
Is that the word choice?
Yeah, that's, wow, wow.
the judge is criticizing an accountant because an accountant wrote a check or just did a journal entry or something and said, well, that's the whole story, and the underlying legal document is the check, and the judge said, a cow does not become an airplane because an accountant so says. The actual transaction here is the change to the constating documents, that is the articles of amendment, replacing the articles of incorporation, that reduces the paid up capital from $100,000 to $10,000. Once that's done, the corporation simply writes a check to the individual. And the individual can be assured that that check is a tax-free check only because the correct legal documentation was done to reduce the paid up capital from 100 to 10. So you might ask, that's like 2 visits to the lawyer. One to stick in the 100 in the first place, and then a second visit to the lawyer for articles of amendment. Why didn't I just put in, if I had to put in 1,000, 100,000, why didn't I just put in, say, $1,000 by way of shares, and then loan the company $99,000? Because if I loan the company $99,000 and I want 90 back, all the company has to do is write me a check in repayment of the loan. And that doesn't require a visit to the lawyer. So honestly, the thing that's actually done most is not putting in $100,000 by way of share capital. It's by putting in some nominal amount like $100 or $1,000, and then the rest of it by a shareholder's loan to the corporation, which the corporation can repay back at any time without changing the constating documents and that type of thing. So that's actually what's normally done. And you as the lawyer, if your client says, hey, I want to put in $100,000 by way of shares, you might say, hey, I can make your life easier. Why don't you put in $1,000 and then put in $99,000 by way of a loan to the corporation, whether interest bearing or not. Because you can take that $99,000 back anytime by just repaying it back, and that's a tax-free transaction, and you don't have to come and visit me a second time. Now, you might say, hey, but my bank wants me to have $100,000 invested that sort of looks like equity, that looks like shares, because my bank doesn't want me to be ahead of the bank or something like that. And if I put in $100,000 by way of shares, it shows the bank that I'm making a commitment. And the answer to that is, you as the lawyer say, well, let's subordinate your debt. That is to write a document that says that the repayment of your debt comes after amounts paid to the bank. That'll make the bank happy, and will still allow you a repayment to yourself. You just have to go negotiate that with the bank first, which is sort of giving the bank notice, hey, I want to take out $90,000. By the way, your money is still safe for these reasons. Here's my business plan. The subordination of debt will give the bank what it needs, particularly at the outset when the bank is loaning you money for the first time and doesn't really know you. 5 years later, they know you, they know the corporation is good. Yeah, sure, take out your $90,000. Yes?
Wouldn't that have, like the situation of like a nominal amount of share capital and then significant loan, wouldn't that have implications for the capital gain if you sold the shares? Like, wouldn't you end up paying like a way higher capital gain?
You pay a way higher capital gain, but don't forget that you've taken $90,000 out with no capital gain on it. No tax paid at all. So you should expect that later when you sell the business or the corporation shares for more, that you will have tax on a capital gain. That stands to reason. Any other questions about reduction of paid up capital? So in my example, this was paid up capital of $100,000. And then we went to paid up capital of $10,000. And the number of shares is still the same number of shares, which is 100 shares. At $1,000 per share. And what we did was we reduced this number. We reduced the $1,000 per share. The other way to take money out is to say, well, why don't I just give back some of the shares, or take back, pardon me, give back's a better word. I say to the corporation, I'm going to give you back 90 of these shares. We call that a redemption. The corporation will redeem my shares. That is, pay me back for my shares.
Doesn't it buyback trigger capital?
No, a buyback, which this is, by the way, another word for this is a buyback, so the corporation is buying back my shares. It triggers a deemed dividend.
Oh, okay.
It triggers a deemed dividend. I wish it was a capital gain because it would only be half taxable. It triggers a deemed dividend of the excess of whatever the company pays me. Let's say the company hasn't increased in value at all. My shares are still worth $100,000. So what happens is I get I get $90,000 cash. $90,000 cash. And I've redeemed, that is cashed in, allowed my shares to be bought back. I've cashed in 90 of those shares. 90 of those shares at $100,000, pardon me, $1,000 per share. Any questions on that? I have a deemed dividend. The paid up capital I'm giving up is $90,000, so I have a deemed dividend of 0. Let's say for sake of discussion, the shares are worth $1 million. $1 million. And I'm going to give back, or allow the company to buy back from me, $900,000 in my shares. And honestly, I'd be hoping for a capital gain, like that would be awesome. In fact, if the shares went to anybody else, it's your company, let's say, and you're allowing the company to buy back your shares, that gain is a deemed dividend to you, eligible or non-eligible? If instead you sold your shares to me, that would be a capital gain. You're selling your shares to your own corporation, deemed dividend. So why would I do this instead of doing a PUC reduction? The answer is, well, the PUC reduction, the most I can take out is how much I put in the first place, which is only $100,000. But if my company's been doing really well and it's worth $1 million, I might want to take out more than $100,000. It makes sense to me that I should have a dividend because essentially the company is paying me money out of its retained earnings, which is what a dividend is. I therefore might have done this in 2 stages. Maybe at some point I do a PUC reduction, and then later on when I do more money, all I got left is to cash in some shares. And if I do that, I suffer a deemed dividend. On the excess of what I get over the paid up capital of the shares that I allow the company to buy back. So what I get is 900, and the PUC of the shares that I allow the company to buy back is 90,000, hence an $810,000 deemed dividend. Eligible or non-eligible depends on the whole RDTOH and GRIP thing from before. Please turn to 84 bracket 3. Corporation redeems, acquires, or cancels in any manner any shares of the class of its capital stock. The corporation shall be deemed to have paid at that time a dividend. I will skip some words. Equal to the amount, if any, by which the amount paid by the corporation on the redemption, $900,000, exceeds the paid up capital in respect of those shares that got redeemed. So 84.3 is what tells us that it's deemed dividend treatment, which again is hideous compared to capital gain treatment. But maybe on the day that I want to cash in these shares, I don't have a buyer for my shares. Plus, maybe I don't want to sell off 90% of my company to somebody else just yet. I want to maintain control. So I'll give them back to the company and the company can pay me for them. Has to be fair market value, which it is in this case. $1 million times 90%. Yes?
Okay, so in the previous example, the 100,090.
Yep.
To get the paid up capital back, there's articles of amendment are filed, the share price is reduced, the company writes you a check for $90,000. That's tax-free. This case, where it's 900, the board issues declares a dividend, and then the company writes you a check for $900,000?
No, the company redeems the shares, which is probably a visit to the lawyer to do a contract that says the company hereby buys back from you, to use your excellent word actually, the company actually buys back from you 90 shares.
So in the first example, you still hold the 90 shares worth $100, Where in this example, you no longer hold any shares at this point in time, right?
In the first example, you recall at the beginning, I bought 100 shares for 100 grand. In the first thing, the puck reduction, there are still 100 shares, I still own 100 shares, it's just that they're no longer 100 grand, they're only 10 grand now.
Okay, yeah.
In this case, I've actually given back 90 shares. There are now only 10 shares issued and outstanding.
Okay.
That's the difference. In one, we still have the same number of shares, we just done this. In the second case, the redemption, we have actually fewer shares outstanding now.
So you've changed the share distribution in the second example if there were other shareholders involved.
That's correct. If there are other shareholders involved, I have reduced my shareholdings. I may now be outvoted, et cetera, et cetera. You're quite right. That's a good place to stop. I just want to, this is the best single personal finance book I know. I actually bought this copy for my wife, who says she has a stack of novels and other things she wants to read first. Thus, she ain't gonna get to this for at least another week. I'm happy to lend this book to anybody if they want to keep it over reading week and return it next week. Or if you prefer, the Kindle version of this is excellent. In fact, I read this entire book on my phone and quite enjoyed it. But I'll leave this up here in case anybody wants to borrow this and bring it back after reading week. With that, have a good reading week for those who are traveling, safe travels, and I'll be watching the Q&A pages. All the best.